Hi, everybody. Thanks for joining. Before we get started, I want to ask everybody to hit subscribe to my channel to make sure you keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen right now for a special offer from our sponsor, The Motley Fool, where you can get the 10 best stocks to buy right now. All right, earnings season is now well underway, and we've heard from most of the big banks in the United States. So we got numbers from three of my favorite banks, and they really show why I own them and why I want to buy more of them over time. So all of these three, Wells Fargo, Bank of America, and Goldman Sachs, are all down by 25% or more from their highs. They all have strong dividend yields, at least stronger than they were, ranging from 2.3% to 2.8%. Surprisingly, Goldman Sachs is the highest of the three. And we heard earnings results from all three of them, and they kind of really reinforced my investment thesis. So we'll go through these one at a time, starting with Wells Fargo. Wells Fargo is the most consumer oriented bank. It's more like a traditional savings and loan than you would expect from a massive mega bank that has, trillions of dollars in assets. Its revenue actually grew quarter year over year in the third quarter by about 4%, and that was mainly due to higher interest income. Net interest income rose by 36% year over year as interest rates rose. The rates they pay on deposits really haven't changed that much, if we're being honest. And the rates that they charge on loans have started to increase, especially on things like credit cards that are directly tied to the Federal Reserve's rate hikes. Their loan portfolio grew by 11% year over year. The consumer deposit base is up by 5%. Really solid quarter. Net charge-offs have started to take a little bit higher, but that's to be expected. We're coming out of COVID still. There were a lot of consumer protections where banks were very, very flexible when it came to loan repayment, and defaults were at a very, very low rate. We're still well below pre-pandemic levels, and I'm not that worried about the defaults. Wells Fargo can certainly handle what's going on right now, and it's a bank stock that I bought in during COVID and plan to continue to add to. Number two is Bank of America. Bank of America reported on Monday morning, and their quarter looked even better than Wells Fargo, if I'm being totally honest. I call them the winner of these three. Their revenue was up 8% year over year. The consumer banking business looks incredibly strong. They added 418,000 net checking accounts during the third quarter, just to name one example. Consumer spending remains very strong. Consumer spending across on Bank of America card products is up 12% year over year so far in 2022. So the consumer is strong. Defaults are ticking up, but not to an unmanageable level. Their loan growth of 12% is even better than Wells Fargo's, and their net interest income rose by 24% year over year. So they said that for every if another 100 basis points in interest rate increases, which is 1 percentage point, would translate to $4.2 billion of annual net interest income for the bank. They have a lot to gain. They only pay a 0.02% on their average consumer deposit. So their net interest margin rises rapidly as interest rates do. And they are just all around just firing on all cylinders and still trading for a very cheap valuation. Goldman Sachs is my big bargain in the banking space right now. They're actually trading for less than their book value despite excellent results. Their earnings in the third quarter were ahead of expectations. Profits declined by 43% year over year, but that was kind of to be expected when you think of what was going on in the IPO market last year versus what's going on in the IPO market, nothing right now. Goldman Sachs is one of the leading underwriters of IPOs, and that part of its business is pretty much ground to a halt. So that's a big driver of its earnings decline. Um, Revenue is down 12%. Again, investment banking was kind of weak. Their trading revenue, which is Goldman Sachs's bread and butter, looked fantastic. Fixed income trading revenue was up 41% year over year. Interest rate volatility will do that, but that was still better than expected. Equities trading was down a bit, but still better than expected. And just really solid quarter all around. They announced a reorganization of their business. The consumer banking side is in my mind, the biggest disappointment recently. That's one of my long-term, you know, potential drivers of growth for Goldman Sachs. They're one of the biggest banks that doesn't have a big consumer banking presence. They've been building it up with their Marcus savings and loan platform. They've rolled out some credit card products. They're the bank behind the Apple Card, for example. Um, but It has been admittedly a disappointment, but elsewhere in the business, Goldman Sachs is looking great. This is a bank that figures out how to make money no matter what the economy is doing. Its most profitable year ever up until the COVID was 2000 and was during the financial crisis, because volatility is good for banks that rely on trading revenue. So all three of these had excellent quarters. Really kind of reinforced why I own them, and I plan to add on all three of these positions incrementally over time. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.